Adam Grimes, and welcome to Module 3, Unit 4 of the Art and Science of Trading. So today's topic is really two topics in one. We are looking at tools for trends and also the patterns that indicate an end of a trend might be coming. So what are these tools for trends? Well, trend lines, classical trend lines we're going to look at. I'm going to give you a couple refinements on those, talk about how I use them. We will look at the trend channel or the parallel trend line. We'll look at some usage for bands, and we're not going to get too deeply into this, but I'll give you some typical things that I look for and also a special trend pattern that is unusual but deserves attention that we'll call slide along the bands. And then we'll look at patterns of trend endings, which I know we have done in a framework, conceptual framework, but now we're going to see them in actual market patterns. So, thinking about trend structure. We've looked at this, right? And you've seen this in different ways, and you know one of the issues is how do we define the swings, and we have tools for doing that takes all of the ambiguity out. But still, if we're reading from a discretionary standpoint, is that the structure, or is this the structure, or is it somewhere in between? And to some extent, it doesn't matter. It's very easy to get caught up in that question, how exactly do I want to define the trend? And what really matters here is that this is going up. And it's going to go up until the point it stops going up. But the problem where the point where it stops going up is we don't know if it actually stopped or is it just taking a pause and going to go back up. That's kind of the whole drama of trading, right? Well, one of the traditional tools that is very useful is a trend line. And I've drawn a trend line on this chart. I'm going to give you all of the points here about the trend line, and then you'll see them through the presentation in different slides. So a trend line is a straight line, and whether the chart is linear scaled or log scaled, we still draw a straight line, which yes means on a log scale chart it's going to be a curve, and that's okay. We'll talk about why in a moment. And the trend line has 2 points of attachment. It has a point which should ideally be somewhere near the end of the trend, and the other point that you want to capture is you look at the high of the trend. So this is an uptrend. You look at the highest swing of the uptrend, and then you want to capture that previous pivot low before that high. So what you're looking to capture is the previous pivot before the trend extreme. If the trend were going down, then what you would want to do in this case is you would want to capture this pivot high, which is the last pivot before the most extreme trend low. So even though the trend line touches here, this is not actually the attachment. This is the attachment. The other thing that we want to make sure we do is we do not want to cut prices. And when I say cut prices, I just mean we don't want a trend line to go through prices. This is a trend line cutting price. This is a trend line cutting price. Now, it may very well cut price after the attachment point, and in fact, that's how we know the trend line is broken. So this is a standard classic tool. Now, let's look at a few refinements. I'm going to draw some trend lines here. So imagine that the chart is not complete. Let's say we were standing here at this point. So this is the pivot low we need to capture. So we would draw our trend line from this point there. And let's just pick a couple more points. Let's say we're looking at, I'll do some easy ones. Let's say the chart ends here. So this is the point we want to capture, and we will try to draw from here to here. Now, let's say I've kind of shied away from this. Let's say that this is the end of the chart. So this is the line that I want to capture. Now you will see, let me erase those red lines. You will see if I'm trying to capture this pivot and I do it from here, what's the problem? I've cut a bunch of prices. So it's not really possible to capture that pivot like that. In fact, I may have to draw a trend line like that. I may only be able to draw a shorter trend line. So the critical thing is that we capture this previous pivot before the trend extreme. So we're capturing the swing low before the trend high, or the swing high before the trend low in a downtrend, and we don't cut prices. We like to go as far back in the trend as we can, but there's a limit to how well we can do that. Now, think about something. Is this a valid trend line? So it's a trend line that goes here. I have caught a swing low, and I have not cut prices. But I would argue this is probably not a significant trend line because the trend is broken. See, the beauty of this, there is logic here. I'm not just giving you meaningless rules. The beauty of this is that if we capture this pivot, we're pretty sure in most cases that it is in trend dynamics. Now, let's say, on the other hand, that it is when I said trend dynamics, that it's in the dynamics of the existing trend. Once we start to draw a trend line like I just did, the trend is probably broken. Now, could we draw this trend line? Could we say the market is in a downtrend here? Here's the low. This is the swing high. So this is a good downtrend line. Let's look at the end of the chart. And could I now draw this uptrend? And if you get out your straight edge, you're probably going to discover that my attachment points aren't exact. And in fact, you can see the example here is not exact. It's okay. The right tool to draw these is not, in fact, a straight edge and an artist's pencil. These are kind of big areas. They're not really precise. So you want to think of maybe drawing with a crayon or something. And depending where you are in America, the way I say that word may sound strange to you. It's one of the words that you may hear a little bit of an accent on sometimes. So that is the basic standard trend line. Now, one of the problems with trend lines is people will say, well, I can draw any line on a chart. That's one of the complaints you will get from people when you start trying to help people and teach people. People will say, well, I can draw any line. And yes, you in fact can. You can draw any of these lines on the chart. But what do they really tell you about the market? That's the question. I want you to draw lines that tell you something that are likely to be useful. That's the purpose for these rules, and that's why so many of these are, I would call non-standard trend lines, which is a polite way to say, I think they're wrong. I think these are not trend lines that you want to draw. Quick review. Drawing trend lines. Yes, you can draw any line, but what we're looking for is the line to mean something. Be aware that cognitive bias is an ugly thing. Cognitive bias will make you think any line is important. If I draw a line on a chart, let's go back to that previous chart. Well, okay, these aren't that important because I drew these, so it's not a fair comparison, but just try this. Get a chart and just draw some random lines. And then look at the lines and say, do I think these are significant? And you're going to be surprised that pretty much any line you put on a chart, your pattern recognition sense, which is a good thing, it's good that you have that, your pattern recognition sense will make you think that any line is important. But because of this is a really crummy answer. You can just see that it works. That's what a lot of people will tell you about things. It's garbage. It's crap. You cannot trust your intuitive sense. But if you think about what the trend line is supposed to do, what it's supposed to show you, what you hope to do with the trend line, that will drive us closer to some rules, which I just gave you. So, the purpose of the trend line is to define what when I say the accepted rate of growth, I mean the rate of growth of something that the market has accepted. Now, that can be, if we're looking at a long-term chart over years, then it truly is a rate of growth. Even a short-term trend lasting minutes, there's still an accepted rate of trend. It may not be growth in some of those lower time frames, but there is a rate of trend that the market has accepted. If we can understand this accepted rate of trend, then we can monitor the trend for something changing. So we can see when the trend is speeding up or slowing down, accelerating or decelerating. Suggested guidelines. So uptrend lines are upward sloping. Uptrend lines are drawn between pivot lows. You saw this already, but here it is in a little bit more of a standard rule format. You want to capture the pivot low before the high of the trend, and you want to draw from the farthest point back in the trend that you can. This is the one This is you're not going to be able to do everything basically. Sometimes you are going to be able to do everything, sometimes you're not. If one has to go, then if one of these, you can't fulfill these conditions, then you drop number 4, and you make sure the others are fulfilled. Don't cut prices. We'll talk about that a little bit more in a moment. And now knowing that, you can see why this is a valid trend line. We have captured the swing before the pivot high. We've captured the farthest trend back, or the farthest back in the trend we could. Could we also draw from here? I suppose so, but it's probably better to draw from there. And we have not cut prices critically before the attachment point. The trend line may very well cut prices, or price rather would cut the trend line after the trend line is drawn, but that is a different thing. So these also are valid. And I'm going to leave this up here and just give you a moment to think about those. Imagine that you're going through. This one is drawn when the market is somewhere here. This is drawn, market is somewhere here. And this would have been the valid trend line. Is this, okay, look, this trend line. I won't try to outline the whole thing. That will not end well. This trend line. Is this trend line valid if I drew it when the market is here, when we've made this high? This is not a valid trend line at this point because it cuts prices here. This trend line would be valid here, not here. This trend line, however, would have been valid connected here at this point, and then, as I've shown you several times, there. So that's how you would draw the trend line, and when you would draw the trend line. A couple patterns we see in trend lines. Well, as trends accelerate. So here's a case where you have a market that's, I'm just going to draw a very subjective curve. Market's trending like this and starts to trend faster. And here we have drawn proper downtrend lines. And you can check those downtrend lines and see why they're proper. And it's necessary to draw lines that slope. And notice this cuts prices, but it's okay because the trend line was drawn here. Take a moment, look at that. Of course, you can come back to these. These are all other examples of trend lines that would have been valid. So one of the takeaways here is people will use trend lines and assume that when they're broken, it's the end of the trend. And that is, in fact, true sometimes. It's also many times not true because what's happening is the trend is just adjusting to a new rate. So trend lines are a useful tool, but we just want to think about how we use them. And I'm going to give you a little bit of homework to do a study on these where you're going to understand a lot more about how they work because you're going to do the work. You're going to see it. The trend channel. So the trend channel is a parallel trend line. So in other words, we draw a trend line, we draw a valid trend line, and then you want to create a parallel version of it depending on what software you're using. Some software you can click and just say make a parallel line. Other pieces of software you can copy the existing line. At the very least, what you probably could do is to draw another line on top of it and then drag that line. And you move the parallel line, which is the trend channel line, to the most extreme swing between the anchor points for the trend without cutting prices. It's a little confusing, but I'll show you. This gives us some idea for trend potential and for exhaustion. Look here, please. So let's just do this one set at a time. Let's deal with this trend line. This trend line we'll call number 1. So I've created the parallel trend line. This is the trend channel line number 1. Where is this trend line drawn? Probably is drawn between these 2 points. So then my anchor point, that was not really a low there. That's okay. My anchor point is then here. This trend line, so it depends where the trend line was drawn, right? If the trend line is drawn here, so then my trend line is anchored, we're looking at number 2, my trend line is anchored here, then my trend channel would be attached here, and you see, I'm certain I can't quite draw it, you see we were through, but not very far. We threw the trend channel a few times. However, I believe my thinking was that this trend line was drawn here. So that the attachment point is here. And these are dynamic. If you're doing this in real time versus looking back in the middle of the chart, you get quite a different answer. So this is the origin. This is the attachment point. What is the most extreme swing in between? Well, you saw if I took this parallel line and attached it here, we would cut prices. So this then needs to be the attachment point. Similar thing for number 3. This is the origin. This is the attachment. The most extreme swing is here. That's all there is to it. It's quite a useful tool, and I use it particularly on longer term charts. And by the way, here's an example of log scaling. I think this is maybe something that we have not looked at, but you should use a log scale chart when there's a very large price change on a chart. Typically this would be a very long-term chart, but anytime there's, say, 100% price change on a chart, you want to use a log scale. Just because if you don't do it, then everything in the low price area is crunched. And this more accurately reflects percents and how the market grows. So this is, you can see, origin, attachment, and look how much time, 2009 to 2016, and here's your attachment point for your trend line. And there are for your trend channel, there are other trend lines we could probably draw in shorter term trend lines, but this is an example of how a trend channel can really give you a sense of big picture, long-term structure. I've talked a little bit about this, but just be aware that if we're looking at, and they're actually semi-log scale, these are actually curves, and this is okay because the typical growth pattern, if you think about economic series, you have some type of curve like that. Just think about how money compounds or something like that. And this actually plays in very well with the trend line, the straight trend line on the log chart. It's actually, believe it or not, logically consistent. I've said several times, be careful of cutting prices. You will sometimes see people do this. I think it's sloppy. I think it's okay. The one case you could do it is if you were only going to act on close. And I'll show you a trick with candlesticks next. But basically, if you've drawn a trend line that's cut through a ton of prices, then what do you think is going to happen in the future? When price touches this trend line in the future, if price has been all through the trend line before, why do we care? So, yeah, that's why we've gone to such lengths to come up with, yes, a rather simple set of rules, but an important set of rules to help you draw these trend lines. Candlesticks. Just be careful because the way candlesticks are structured. Visually, the body of the candle is much more obvious than the shadows. So, perhaps because of this, you will see people when they draw trend lines, they'll be willing to draw trend lines like this, just basically connecting the bodies of the candles and completely ignoring the shadows. Now, if you are only executing on close, that's okay, but just keep in mind, like if you want stop placement or something at a trend line, you can have a very big shadow beyond the trend line and some kind of spooky things can happen. So, how do we use trend lines? Well, they probably don't work like you've been told in most books. Every change of trend will include a trend line break, but there are a lot of false signals from trend lines. I do think that it's a little bit silly to think that big pools of money are pushing markets around based on trend lines. You also see the same patterns of trend lines on non-traded data series. It's difficult for me to imagine that, say, the Fed is changing interest rates based on trend lines, or that GDP is changing based on, or CPI is changing based on trend lines. Though we can apply these, again, I think it's primarily cognitive bias. It's a huge thing. But just be aware that the trend line can give us another data point for trend strength, and the trend channel deserves attention. If it's something you haven't seen before, that parallel trend line, it is a great trick that can really change the way you see the market. So bands. The typical bands that people use, Bollinger Bands, are probably the most common. The bands that I use are Keltner channels. They're actually not proper Keltner channels, but they're Keltner channels around a 20-period EMA, and I believe they are 2.25 ATRs. So Bollinger Bands work on a number of standard deviations of price away from the moving average. Keltner's a little bit more stable, a little bit more logically consistent. I prefer Keltner's. Having said that, most other people probably prefer Bollinger. So use whatever you're comfortable with. Experiment with both. If you don't have a bias, I would encourage you to start looking at Keltner's and see what you think. So one of the typical things that we see is when a market goes up to a band, this is another confirmation of trend strength. Or here, notice the points where the market comes down and touches the band. And you see this. If you look at this area in the band, between the band and the moving average, you can kind of see, I'm just going to draw very sloppily, but just get the idea, that most trends kind of fluctuate in that area. If the market's in an uptrend, we're not going to see a lot of action here. We shouldn't see a lot of action here. If the market's in a downtrend, we're not going to see a lot of action in the upper part of the band. And in fact, now crossing the moving average does not mean game over for the trend, but you'll notice in this case, it was. And when we crossed the moving average into the other side of the channel, that indicated trend dynamics were changing. The main thing I want you to take away from this is that this kind of fluctuation outside and back in is very typical. This is an exhaustion point, climax point, which we'll come back to in a moment. Trend strength. So this relationship of how far out and how far back in is one way to gauge trend strength. The market's in an uptrend here, right? Market is in a downtrend here. It's hard to, we can argue over the exact transitions, draw trend lines, say we went through a range, but somewhere in here we're in an uptrend, somewhere in here we're in a downtrend. And just notice this, like the market can't stay outside of the bands very much and eventually can't even get up to, this is a rounding top sort of thing, by the way, eventually can't even get outside of the band. Now compare what we see here. We see a lot of pretty sharp and deep thrusts below the channel. And in fact, this long area here, I'm going to erase these marks so you can see more clearly, this long area here where the market just slid along the band. So if you look, if you're using the band as a reference, for the uptrend, use the upper band. For the downtrend, use the lower band. And you'll notice this gives you one way to read trend strength. Now, we can quantify this in a lot of different ways, but I think it's enough to see it subjectively. It's a very powerful subjective tool. Slide along the band's trend. So the normal trend pattern, what's the normal trend pattern? You know this, right? That's the way trends normally move, with trend and then a pullback. Every now and then we get something that looks a little bit more like this, where the market just pushes against the band and sits there. And this is what I call the slide along the band's trend. I have a couple examples. Actually, here's one. This is the previous chart, which you can see a pretty substantial slide along the band's trend. Here's another one in the US dollar. And these are unusual. But what this really is it's an absence of the normal trend fluctuation. That absence of a pattern is a pattern in itself. And the fact that there are no reactions against the trend suggests a very strong trend. You do not want to be in a situation where you are fading or going against a slide along the band's trend. However, this is one-sided trending action. Usually in a trend, the buyers hand off to the sellers or, vice versa in a downtrend. And this is how the trend makes progress. There's a little bit of a psychological reset as we fluctuate. We don't see that here. So it's very one-sided, and many times there's like a vacuum on the other side. These trends can go a lot further than anyone would expect. We've seen currencies in recent years just go and go and go for a very long time in individual stocks. So don't get on the other side of these trends. However, you also have a problem positioning with the trend because when they do fail, they'll do so quite dramatically in most cases. And let's go back and take a look at these previous charts. This one was actually fairly polite, but I suspect it's because the trend didn't really end. So you had a significant pop against that slide along the bands. A little bit. I would not call this the same thing, but notice how hard we came off of the upper channel there. Look here. Look how dramatic that is. And if you're wondering how dramatic that is, well, just use the channels. So for many months here, we haven't even been to the bottom channel. All of a sudden, we start having some down days like we've not had for many, many months. And on this particular, what is it? 1, 2, 3, 4, half a year, 6, 7 months, there's no sharp sustained sell-off like there is here. And that's probably a reaction to coming off the slide along the bands trend. And look at the same thing here. So I think this trend may not have really failed, but we have a little bit of a dramatic pop against. Not here though, right? So you just want to be careful. You don't want to be, when you're looking at these slide along the bands trends, you don't want to try to trade them expecting these normal fluctuations, because you're probably not going to get this. What you're going to get is this. And if you're trying to buy here, you're going to end up getting stopped out here. So trend ending patterns. This is sort of a first look at this, and I want to point out 3. One is the exhaustion. And what happens in an exhaustion, this normal trend pattern kind of short circuits and becomes almost vertical. This creates a vacuum on the other side. What moves markets conceptually is people switching camps. Markets do not go up because everybody thinks a market is going to go up. Markets go up because people buy. This is important. Markets go up because people buy. Why do people buy? They buy because they were neutral or bearish, and they've now changed their opinions. And this is what this structure causes, encourages. This trend structure is both a reflection and a cause of this. But at some point, when everybody who wants to buy has bought, then the market just collapses into the vacuum. That's how an exhaustion works. Rollover is kind of the opposite. Rollover is you have a trending market that all of a sudden just runs out of steam. And we've seen this and already talked about this in terms of trend, swing patterns, right? And then the third, which does sometimes happen, you can very well have a trending market that all of a sudden has strong surprise momentum against. There are no guarantees. Exhaustion or climax. So the bands are a good reference. And typically what we see this fluctuation, right? But when we spend a lot of time outside the bands, it's probably climactic. There's some other patterns that we can look for, and this is probably a climax to the downside. Just simply means here, everybody that wanted to buy gold bought. And this was the high for quite a long time. And it's a local high. And everybody who wanted to sell at this point into the panic had sold, and this knocked in a fairly significant low. Sometimes these will mark, it's not unusual in a commodity. I thought this was a different year, actually. It's not unusual. You'll find the significant multi-year high in precious metals looks very similar to this. So it's not unusual to see this at very big turning points. Here's not so obvious of a climax, but it is. And here's a bar that has a wider range than most bars, though we've had some volatility here. And this is a point where the candlestick is significant, or is probably significant, that you have a little bit of an experiment to see, is the market going to go lower, and we end up closing higher. Think about this bar. Actually, I'm just going to give you 5 seconds to think about that bar that I'm pointing to in chart story format. Think about it. See, the chart story, if you think about the dynamics there, if you think about the big surprise on the close and what a difference it was. Now, do we have some surprises before? Yes, we did. But the bands show us that this surprise happened at a much more extended point, and a much more extended point psychologically. So that's why this can hammer in a significant and lasting bottom many times. Now, you do need to think about, here I've really compressed, this is the S&P during the financial crisis, and we had many small climax bottoms. And every one of these until what is it, number 6, led to new lows. So on one hand, I guess the message here is that don't expect that every climax bottom is going to lead to the final reversal point. However, each of these did. I'll just mark some of the swings. This made a new low here, but still. Each of these did lead to a significant bounce. And when we trade, many times what we're looking to do, there's a lot of different ways to trade. I want to be careful to say there's one way to do it, but many times what we're looking to do is basically just to take a little piece out of the market. And people who like to trade reversals will find that these slightly overextended points, even if it does not really bring with it an expectation of an ultimate trend turn or termination, that there's still value and still good reason why you might want to trade these. And most of these trades you could have structured, even in a very bearish environment, some profitable long trades. Here's an example of a market rolling over, and we can draw a trend structure. And I've chosen messy examples deliberately, but you can kind of see this thing just ran out of steam, and I've already pointed out some other examples. This is what classical charting would call a rounded top, and perhaps this is not the cleanest example, but I want to show you some examples that aren't super clean also. So here's surprise momentum against. You've seen this chart, I think. Yeah, we've seen this. So you have a little bit of the slide along the bands, and then very sharp momentum against. And how do you know it's sharp momentum against? Well, you can just look, for one thing, right? This is a pretty big downswing in context of the previous swings. The other thing is the lower channel. We're really outside the lower, and I actually don't think I trace the lower channel accurately. I can do better than that. But this is certainly, if you look at the other times, we have been outside the channel. This is more, right? You have this whole big bar outside. So that is proof that something is going on in terms of market dynamic. Those are 3 very powerful patterns. You're going to see a lot of them. Just a real quick review here of those. Actually, we're going to do a review on the next slide. So the exhaust, the rollover, the rounding top or bottom, and then the Momo, surprise momentum against. So real quick review what we did here. Trend lines, how and when to draw. You draw them in trends. You don't draw them in ranges. Think about whether you want to cut prices or not. Experiment with my method. You also probably want to spend a little time looking at the trend channel, which is something different than the Keltner channels. We also talked about how to use bands and channels. Then we looked at 3 end of trend patterns: exhaustion, rollover, and surprise momentum against the existing trend. So it's a lot of information. You may want to go back and look at some of these again. The homework is certainly going to reinforce some of these concepts, and I think you will find that productive and useful. I'll see you back for the next unit. Thank you.